You're listening to AI Prism from Seoul Economic Daily.
90 trillion won, $16.8 billion, and 2,299. It's Monday, July 6. Here's what today's story could mean for the Korean market. So, if you are holding a standard KOSPI index fund right now, you might actually think you're diversified across the broader Korean economy. But our mission today is to decode those three numbers, and we'll show you why you're really holding a highly leveraged, heavily concentrated AI semiconductor bet.
Right, yeah. And I mean, the primary catalyst for that bet actually lands tomorrow. So we're looking at Samsung's Q2 preliminary earnings. Consensus is projecting this massive memory chip recovery, which would push operating profit to a record 90 trillion won. That's about $64 billion.
Wow.
64 billion. I mean, the sheer scale of that 90 trillion won number is just wild. But it's really what's happening beneath the surface that you need to pay attention to, because foreign institutions are taking that data and just aggressively cramming capital into the space.
Oh, absolutely. Yeah, for example, Hong Kong's CSOP Asset Management runs a 2x leveraged SK Hynix ETF that just hit $16.8 billion in assets under management, which, get this, makes it the largest single-stock leveraged ETF in the entire world.
Yeah, and they also just listed a new Coco SPI 200 ETF that allocates an incredible 60% of its total portfolio exclusively to Samsung and SK Hynix. So, I mean, the benchmark index itself is effectively functioning as a semiconductor vehicle right now.
Wait, 60%? That's insane. But if institutional money is that heavily skewed toward just two specific memory chip companies, doesn't that inherently just suck the oxygen out of the rest of the room? I mean, are other sectors just, being starved of liquidity here?
Totally. And the mechanism behind it is pretty ruthless, to be honest, because institutional algorithms and these massive passive ETF flows are blindly buying a KLKO 200 index that's completely top-heavy with Samsung, while active fund managers are suddenly trapped.
So they have to keep up.
Exactly. To keep up with the benchmark's performance, they're forced to liquidate their mid-cap holdings, and abandon IPO allocations just to chase that exact same semiconductor momentum.
Man, that perfectly explains the absolute bloodbath we're seeing in the broader market. I mean, in the first half of the year, 14 out of 18 IPOs are currently trading below their issue price, and total new listing proceeds have plummeted 49%.
Right, it's a complete liquidity drain. But, the real danger here for traders isn't just a lack of market breadth. It's the structural stress this much concentrated leverage puts on the market's actual plumbing.
Wait, okay, this brings up our third number, 12,299. I know leverage trading is inherently risky, right? But aren't ETFs specifically designed by market makers to track their underlying index perfectly?
Usually, yeah.
So how is the core ETF structure feeling so badly that we saw a record 12,299 tracking error disclosures in June alone? I mean, that's almost an 89% jump since March.
So think of it like trying to pour water from a fire hose into a teacup. The market makers are the teacup here. They rely on the continuous creation and redemption of shares to balance their books and keep the ETF price aligned with its actual net asset value.
Right, the basic arbitrage mechanism.
Exactly. But when you have tens of billions in leveraged foreign capital violently whipping around a single sector intraday, the sheer volume and speed just completely overflow that daily pricing structure. The ETF simply cannot update its pricing accurately in real time.
Oh, wow. So if you're trading this as a retail investor, you might think you're buying the dip on a semiconductor run. But because of that tracking error, you're actually wildly overpaying compared to the real-time value of the underlying assets.
Yep, or underselling during a panic, which is just as bad. And this is exactly why local traders are heavily shifting their strategies to survive this gap risk. Retail investors have already dumped over 2 trillion won into covered call ETFs this year alone.
And just to be clear on how that works for everyone listening, they aren't just buying insurance. They're actively selling upside call options on their holdings to generate a cash premium.
Right.
And that premium basically acts as a buffer against these violent intraday swings. So they're willingly capping their maximum profits just to survive the volatility.
They have to. But the landscape they're trying to protect themselves against is it's shifting again. The $1 market is officially moving to a 24-hour, 5-day schedule. And concurrently with that, SK Hynix is listing an ADR in New York on July 10th.
Okay, wait, let's pause there. With SK Hynix trading directly on U.S. exchanges and the Korean currency market suddenly open 245, Well, doesn't that just mean the arbitrage window never actually closes?
That is the massive takeaway here, yeah. Market makers will now be adjusting Korean ETF pricing based on overnight action in the US.
Wow.
So the gap risk isn't just an opening bell phenomenon anymore. The continuous currency trading, combined with a US-listed Korean tech giant, means that pricing adjustments and the resulting volatility, they'll just be continuous.
So sizing your KOSPI positions around a massive catalyst like tomorrow's 90 trillion won Samsung print, it isn't just about guessing the direction of memory chips. It actually requires factoring in the reality of these historic 12,299 tracking errors and this entirely new continuous 1 to USD market structure.
Exactly. The underlying structural mechanics are honestly dictating the actual returns more than the corporate earnings themselves at this point.
Which leaves you with a serious question to chew on as you watch the open tomorrow. If a single tech sector now dictates the liquidity, the volatility, and even the basic ETF structure of a nation's entire benchmark index, are you still investing in a country's economy, or are you just trading a proxy for global AI?
You've been listening to AI Prism from Seoul Economic Daily.